Hey, what's going on, everybody? Welcome back to the Commercial Real Estate Playbook. This is Sita Dambuya, a capital markets and capital sourcing expert. And in today's video, I'm going to cover the biggest mistakes that developers make when they're going after institutional capital. So, of course, as I mentioned in the previous video, institutional capital is when you're getting the majority of your equity from one large investment firm versus raising money from a whole bunch of different investors. And it's very competitive, it's very difficult. Most people are not successful in being able to source this type of capital. And I'm going to go over a few reasons of why and what the pitfalls are. All right, so first, what is institutional capital? Just a quick recap is when you're going after one large check from an institutional firm, maybe it's a private equity firm, family office, life insurance company, and it's incredibly competitive and they require a very, very strong track record to be able to get deals funded. But the benefit is you can raise the majority of your equity in one check as opposed to having to deal with a whole bunch of different investors. And you don't have to worry about marketing, you have to worry about hand holding. They're professional investors, and you can really just get deals done. And it's very great for scaling. But it's very tough. So we're going to go over some mistakes and how you can get around it to be able to successfully source institutional capital. All right, mistake number one, underestimating the track record needed. So I cannot stress this enough. Institutional capital really looks for like a very, very, very strong track record. I've seen very strong developers with very strong track record in portfolios. They've done several deals, and institutional capital will come back and say that it's just not strong enough. They want to see more before they be willing to invest. It's very competitive because these groups they see a lot of deals. Like they see a lot of deal flow. A lot of people would just love to be able to raise capital from one group as opposed to raising capital from several individuals. You know, think about it from this perspective. A lot of people in real estate, they're developers because they like to develop. They like to acquire deals. They like going through the process of finding great opportunities, coming up with a business plan and strategy. They like going through like, all right, we'll renovate this, we'll renovate that, we'll do these upgrades, we'll raise rents. Here's our 3 to 5 year plan. We're gonna exit. They love that. What they don't love a lot of times is raising capital and talking to a whole bunch of different investors. So it's ideal for a lot of people who are in the development space or the acquisition space to get somebody else to do it and be able to outsource that whole capital raising. And they can do that by going to an institutional firm. So you have a lot of people, a lot of developers and operators going to these firms. So they see a lot of deal flow, and these are professional investors. They're using other people's money too. They're raised capital from other people. Sometimes you get firms like maybe a family office where it's like, a family grew their wealth over generations and they're just trying to deploy it, be good stewards. But a lot of times they're using other people's capital and they're trying to preserve or grow the capital for those people. Ideally both. So they're going to be very selective about who they actually invest in. So they want to make sure they see strong track record. They want to see sometimes like thousands of units. They want to see like you've done a lot of deals that are very similar with very strong success. They want to see, did you exit with strong IRR? Did you meet the business plan, get good returns from all of your different exits? They want to see that rinse and repeat. They don't want to gamble. They want to put their equity into a operator that they know can deliver, and they get so much deal flow that they can be that selective. They'll have a team of analysts where all they do is just look through deals and study the track record of developers and making sure that they pick the cream of the crop. So a lot of people underestimate how much track record you actually need. So that's number one. So make sure that you have a very strong track record. And if you don't, always have relationships with more experienced developers. If you yourself have a strong track record, but it may not quite be there to be able to get some institutional equity, look into having a co-developer. Be able to work out that structure ahead of time. You want to have that relationship built in and be in a situation where you can have somebody that you can call up. Say like you have some institutional firms, you talk to a few of them, and they keep coming back saying they just really wish you had a stronger track record. It's much better to be able to have a relationship with somebody that you already have a good relationship, we know, like, trust, and they already have some kind of expectation of being a co-developer because you want to negotiate before you have a deal. You don't want to be in a situation where you got this deal under contract and you're trying to raise money from an institutional firm and they turn you down, and now you have earnest money on the line, but you can't raise the capital from this firm, and now you have to go find a co-developer in order for them to give you the go ahead to fund your deal. Because once you're in that position and you're working on time crunch, you got money up, now you got so much skin in the game, you don't have any leverage to negotiate. So you want to build that relationship with co-developers ahead of time. So now that you're at the point of attack, you have somebody you can already call up that you've already kind of spoken to, that you kind of have an understanding of what they would look for from a co-developer standpoint, so that you're not sitting there in a position where you got to give up a whole bunch of equity just to be able to get the deal done. You want to be able to think about that on the front end. And another thing, the track record that you want to have needs to be specific to the type of asset. If you've done a lot of multifamily and you've done 500,000 units of multifamily. If you're doing a hotel deal, then that track record isn't going to be as strong because you're doing a completely different asset class. There's a different operation structure. There's a different understanding and methodology of how you run that type of real estate versus multifamily. So you want to be specific in terms of niche, asset class, market as well, and property class. If you've done only class A apartments, super luxury, high end, very nice multifamily properties, and now you're going to an institutional firm to get funding for a class C, something that's hood adjacent, is not going to be a good time for you because that's a completely different type of asset with completely different type of operations. Yes, they're both multifamily, but you're dealing with a different type of person and tenant, and the operation just has a different philosophy. So if you don't have that background and track record with that particular class, then institutional firms are going to pick up on that and understand that you may not be equipped to be able to handle this type of asset. So make sure that your track record is relevant to the asset you're trying to acquire or develop now. All right. Mistake number two, leading with the deal instead of the relationship. So this goes without saying, but I'm gonna say it anyway. Institutional firms and investors, they're people too. They want to do business with people that they like, people that they know, like, and trust, and they want to really have a relationship with whoever it is they're investing equity in. You gotta look at these partnerships. That's what it really is. Yes, they're investing in your deal, but it's really a partnership. You guys are going to be tied at the hip for years to come as do you operate this asset. Their money is in it, they're invested in you, and you're invested in them as well. It's a partnership. So they want to make sure that they have a good relationship with the people that they're partnering with. And you may come to them with the deal initially, but don't be so focused on just trying to get a deal funded that you forget or neglect the relationship building the process. You can keep it professional, but build rapport with them. Understand kind of, what do they like? What are their interests outside of that? You want to really kind of have some kind of professional but a little bit friendly engagement with them as well. You want to make sure that you guys have an actual bond outside of just this particular deal. And that's important because a lot of institutional firms, their job is to deploy capital. So they don't want to just deploy capital into one project. They want to build a relationship ongoing to where they can go back to the same developer over and over again and keep funding their projects. Because once they build a relationship with somebody they trust and they know that they can deliver returns that they need for their investors, they want to keep investing in that developer. That could be you, but you got to be willing to really build that relationship so that you guys can keep going and doing business on an ongoing basis. Like it's helpful if you really build a relationship beyond just looking at deals. Meet them for coffee. Meet them for lunch. If they're in a different city, it may make sense to fly out, or if they happen to be in your city for a while, meet up with them and really build that relationship in person. Remember, it's really about the relationship. That may be the difference between them funding your deal versus funding somebody else's deal. A lot of times people just have very personal reasons for doing things. It may be the numbers on your deal is better, but they have a better relationship with another developer and they end up funding their deal. So make sure you really focus on building a relationship and doing things outside of just the deal. But at the same time, send them deals. Get in the habit of staying in their face. First things first, a lot of times when you first approach institutional group, the first deal you send them likely won't get funded, and that's okay. You want to build the relationships over time. It may be somebody that a group that you send them a deal, and you guys start the relationship that way. They don't fund that deal, but over time you keep sending them deals, keep sending them deals, keep talking to them, keep checking in, and it might be 6 months from now, a year from now, 3 years from now, where you guys are able to connect on a deal. So make sure you have that ongoing communication. And sending deals is a great way to stay up to date and to build rapport. One, it really just keeps you in their face, so they know that you're actively looking, so you stay top of mind. And two, it helps with understanding what they're looking for. When they don't invest in your deal, they pass on the opportunity. Make sure you ask why. Understand what it is about that deal that turned them off. And that'll help you understand what it is they're looking for. And once you start doing that with a whole bunch of different groups, then you can start getting a feel for, all right, here's what institutional capital is looking for. And then that you can throw some of that criteria into how you look for deals. One thing for us, for example, we spoke with different groups about institutional funding to be able to fund some of our projects. And one of the things that kept coming up across multiple groups was the untrended yield on cost. A few of them really wanted to look at that metric. Like that was one of the main metrics that they looked at when it came to evaluating deals. So we incorporated that into our acquisition process and built it into our underwriting model. So things like that just really help you to fine tune the process and to where you can really hone in and find deals that you know that they're going to like before you even have to send it to them. Mistake number three, not understanding their investment strategy. So every investment firm is going to have some kind of investment thesis or some kind of directive. Some may be we only invest in multifamily in these specific markets, maybe in the Southeast or the Sun Belt, and we only do acquisitions. We don't do development, only existing buildings. Or some may be we invest in ground up or acquisitions, but only in Georgia, Florida, South Carolina, et cetera, et cetera. So you really got to understand what it is each particular group. You want to really track it, keep a profile for each institutional firm that you look at so you understand it. You want to constantly update it. As you check in with them, sometimes their investment thesis may change over time or their criteria may change over time. You want to update it. You want to have up to date understanding what they're looking for and make sure that as you source deals, you can filter out, say, oh, this won't be a good fit for this group, but I think this group would be interested because you understand their thesis. So you got to really do your homework and be able to understand what each group is looking for so you know who to approach with what. This also goes back to sending them deals over and over again because over time you'll be able to see what they like and what they don't like, and you can really fine tune, what their criteria is beyond just kind of the high level specifics. Another thing, it really helps you with being able to tailor your pitch. Like if you're going to them with a deal, you know what to highlight for that deal. Some, especially like you may have some investment firms that, they're an institutional capital firm that does equity placement, but they're more impact investment. So like say they fund affordable housing specifically, and they really want to see an impact. They want to see 50% AMI, 60% AMI. They want to see community development. Once you know that, you can tailor your pitch or your ask to that thesis versus another group may only be focused on returns. It may be the same project you present to both of them, but you'll tailor how you present it. The first group, you may highlight just how much community impact there is, how much affordability is going to be structured into it, how many people are going to be helped because that's what they're looking for. Versus the second group, you may stress that this project has a 18% projected IRR or 20% projected IRR, or we were able to secure debt because it's affordable housing. We're able to secure very low cost debt, which means our returns are going to be much better. So you want to really understand what it is they're looking for and tailor how you ask them to that specific request or criteria that they have. Mistake number four, overcomplicating the presentation. A confused mind says no. So you really don't want to give too much more information than what is actually needed. And that goes back to mistake number three of not knowing the investor strategy. When you really understand what their thesis is and what they're looking for, you can tailor your pitch to be able to meet those specific requirements and highlight those or put those first. You really want to focus in. sometimes, they're going to be very numbers driven or returns driven, and you want to make sure that that's spelled out clearly. You always want to make sure that the returns and numbers and the financials, that's spelled out clearly, but sometimes you may need to emphasize it a little more. If you're going to a firm that's going to be primarily focused on just maximizing profit for their investors, you may not need to spend too much time talking about the impact and how it's an affordable community development project. Even if it is, you include that, you can put that in there, but you don't need to, lead with that or put making so much your ask about that, because that's not something that they're interested in. They may look at it the wrong way and say, all right, with this being community development and affordable, they may look at it as like, oh, well, it's more of an impact investment project rather than something that's going to really be uh, maximizing returns. So you don't want to confuse them. You don't want to include more information as needed. You want to keep your pitches and your pitch decks, your executive summary, relatively simple. And sometimes it's even best to tailor and have multiple executive summaries depending on what group you're presenting to or what types of groups. You may have a deck that you're going to send to impact investment in institutional firms. If you got multiple that are looking to do community development investment, you may tailor one pitch and one deck for them. And then you got some that are just purely returns. You're going to have another deck for them. So you want to make sure that you simplify it, keep it as light and lean on the information side as possible, and then also have additional information ready. So if they do have follow-up questions, they do have request other information, then you can pull that out, readily. So have it available, but you don't necessarily need to put everything in the beginning and then just kind of overwhelm them with information. You also got to remember that they're looking at a whole bunch of different deals, and sometimes just having too much information becomes overwhelming, and they may not even want to look to it. These are people too; they're human. So certain things that are in human nature, to avoid, stuff that'll cause pain and strife, such as reading something that's just way too complicated, that'll turn them off without you even realizing it. So you want to make sure you keep your pitches and your material as simple as possible, but be ready to provide that backup information if requested. All right, so if you got some value out of this video, please go ahead and like and subscribe, share with somebody, comment. To wrap things up, institutional capital is a huge tool. It's a huge way to be able to scale and grow your portfolio, and also helps you to keep your team lean because you're not focusing as much of your in-house resources on raising capital. You're instead having conversations with people who do it professionally. So it's a great tool, but it's incredibly competitive. So you want to put yourself in the best position possible to be able to capitalize and get these funds. So if you got some value out of this, please go ahead, like, subscribe, share with other people. And if there's any other mistakes that you see, anything that I left off, please go ahead and include that in the comments. And also let me know what other videos or what other information you want to see. All right.